Hi, good evening. Welcome. We finally go live, and yeah, I think YouTube is playing along this time. So really good to see you all, and thank you for coming along. So tonight's Wednesday workshop is about what I would do if I started from zero today. So I'm going to show you my whys, my how, and I'm also going to give you a sneak preview of my current portfolios with my favorite platform. And then we can move on to some questions and answers at the end. So I'm hoping it'll take about 30 minutes and you can get a real flavor for how I invest and how you can start investing. This is what it's about. Because if you looked at last week's live, which we covered the lessons of 2025 and the plan for 2026, the key message there is to take action, and you learn more by taking action. And just in a summary quote for today, you will learn more by taking your first investment live than reading 100 books about investing. We can all be a book nerd on how to do this or how to do that, but until you take the action, you will really understand and you will learn so much faster. So that's the big takeaway for that. So today we are going to cover several aspects of this. So we'll start with the foundation. Always a case of where do you want to invest? That's always a key question just to start with. Then we're going to explain ETFs, try and explain this minefield a little bit, try and make it a bit simpler for you, because really you don't need to overcomplicate it. Now the modern world, keep it simple, far better. I'm going to show you my real portfolio. I took some screenshots earlier today, so I will show you my real examples of what I hold and how I would model exactly that if I was starting today. So you've got exact framework to start with. And then I'm going to show you what you can make as an action plan to start taking the steps to make it work really well for you. I am going to apologize if the camera is shaky because it is on a table. And yeah, there we go. We get there anyway. So if you're new here, welcome. My name's James. So you're here. Welcome to the Wednesday workshop. I want to do this every Wednesday, give you a classroom style setting so I can kind of educate you more on specific things. And please do ask any questions as we go through. Really appreciate that. I will answer as many questions as I can at the end of this live session. And then also any further questions I can obviously give further content going forward. It is a two-way thing. So I really want you to participate, and that helps you get more value out of this. This is what it's about. It's one thing me telling you how it works, how it's worked for me, which is great. I would like to try and make it more realistic for you. So ask me the direct questions, and I'm more than happy to help. So the big foundation, and this is where so many people get lost. So the foundation of investing is to find a place to put your money. So it's the same as finding a bank. It's about who you feel most comfortable with to hold your cash. So I would guess, hazard to guess, at least 99% of you are going to have a current bank account. You go with a trusted name normally, and exactly the same when you're investing and putting funds to investments. Don't go out and find anybody that comes to you in some marketing spiel. Just go for one of the big names. That's why I've tried and tested all of the platforms that I currently list in the description below. Where my favorite has been for quite a long time now, maybe about 2 years since I've been using InvestEngine. InvestEngine has been my platform of choice because it's just easy, it's free, and I just like the way it works. And that's why I encourage anyone to just open the account. Very straightforward, about 2 minutes by the time you do your identity check, the normal bits and pieces. Try it for yourself. You don't have to commit any money. Don't think of that. Open the account, have a look around. If you like what you see, start. But if you don't, try another one. Some people have a preference more than the other. So that's why my favorite, as I say, is InvestEngine. My second would be Freetrade because of the variety of choice that they have there. And again, that's another free platform. And my third favorite would be Lightyear, just because it gives more European exposure. And I think that's kind of something that's kind of a nice platform. So it means from a banking protection point of view, you are a little bit more spread. Otherwise, if you invest everything UK heavy, you might want to diversify actually where your funds are sitting. So again, it's just a safeguard for yourself. And again, that's where diversification is not about just what you buy, it's where you put your money in order to buy. So you want to make sure you're hedging yourself and diversify a little bit. But that's why, again, try one. When you're starting small, don't put money in all three. My first tip, I would, until you're playing with 5-figure numbers, 10,000, 20,000 sort of numbers, start with one platform. Start with the one that you feel best. By all means, open all three, have a look around, see if it fits your style, just get a feel for it. You're not committing to anything. And that way you'll feel more comfortable. Again, this is where actions speak louder than words. By at least having a look, open the platform. Okay, like this one, like this one. You get used to just looking around, actually be a participant and not sat on the fence. Because that way, again, you get used to reading the language and seeing what you like, any of the analysis. Do you like the charts? Do you like the numbers? Do you like the history? Do you like the favorites or what everyone else is buying? And do you go with the herd, or do you want to be able to look at your own figures? And again, this is where you start to find out about what drives you and what you want. Okay, so that gives you the overview on the foundation. So it's all really with the platform. Try them again. Just try them. It really is the best way. So I would always do that first. Then we come on to segment 2, the ETFs. Now, ETFs have been a big buzzword maybe for the last couple of years now. And the best way to think about it is you're buying a pre-made shopping basket with lots of stocks inside. So instead of going to buy one share of Apple, for example, you'll buy one share of an ETF. Now, the ETF is a basket of a portfolio which is pre-selected. So you can have all world, which means it has normally the all world ETFs cover around 3,000 to 5,000 different companies. So it's very broadly covered. It means then you ride a very steady progression in terms of growth, but also you're protected if there's a decline. That can be really nice, but it is obviously hedging one for another, and it's a more balanced portfolio. And if you are starting, I would highly recommend, highly, start with an all world ETF. Okay, because you want to just start with small bits, start to just feel the action of buy your first £100 of an ETF. You will remember that moment for a long time, but again, taking the action it's going to resonate with you, and you're going to learn more than, oh, I need to overanalyze all these stocks. No, you don't. Just stop. Don't overanalyze. Just take baby steps. Okay, because my bet is if you put small amount of money on investing, you start to build your own confidence and your own emotions. You start to find out whether you are too edgy for investing. That happens to people, and it's better to quit while you're ahead. It's not gambling, it's about calculated guesstimates, in the best expression, because past performance is not a guarantee for future returns. And with that, I'm not a financial advisor. I've only learned from my own experiences, and I can tell you that from how long have I been investing now? It over 25 years already. And I've tried the gambling effort, the meme stocks, the ones that everyone buys into. They go to the moon and they crash. I've even tried some of the cryptos, again, gone to the moon and crashed. Lost a lot of money in the process. And that's why I would urge anyone to just take the baby steps and keep your capital as safe as possible, but allow it to grow on its own and nurture it. Because otherwise it's like gambling. It can be if you want it to be, or you can keep it nice and steady and look at historic returns and say, that average looks really nice. I want some of that. That's what you want, especially when you're starting. And again, when you're starting to do the reviews of the different ETFs available, you can compare like for like. And again, choose the one with the best historic returns, because that is likely to continue. Now, there is a small caveat to that. The small caveat is always the cost. Now, that's something you need to really watch out for. The cost, often called the TER, can be the ongoing charges. Any of those, they shelter them in different names. They can vary. They can vary. And I won't do it in this lesson because I want to cover broadly everything, but I will cover through how to select your ETF. I want to go through very detailed about how I go through it and how I'd recommend you do it, so you can make a chart. It doesn't have to be scary numbers. It's just comparing about 3 or 4 different ETFs that you want to buy and how you can select the one that might be best for you. Okay, so just going through those things I've considered about growth and costs, because they're the 2 things you need to consider. If you wanted, so let's go back a step. The All World ETF is very broad. As I say, it covers 3,000 to 5,000 companies. They vary a little bit with the way they're indexed. Okay, so just bear that one in mind. So you obviously have heavily weighted in the S&P 500, which is the American stock market. It's the 500 top companies in the US. So even All World ETF, around 60 to 70%, somewhere of that nature, is covered with the S&P 500. All of the other stocks are likes of China, Japan, Hong Kong, even Asia. A lot of other companies, which can be very mixed. So that's why it can be more volatile, but also it keeps everything more steady. So if you wanted to take more of slightly more risk, and I say slightly because it's marginal, it's very marginal. The S&P 500 alone has been outperforming the All World ETF by a good number of years. As a reference point, the annual return, annualized for about the last 20 years on the All World ETFs, is around 7 to 8% a year, average. Okay, now bear in mind, average give you the benchmark. Okay, some years are better, some years are worse, but you can be pretty sure it's around there at the moment. The S&P 500 is a higher return normally, but it can be more volatile, because with that you get more good years and you get more bad years, but on average it is better, and the returns are normally around 10 to 11% a year. So you can get more growth, but don't expect growth from year one. In a general kind of aspect to look at this, what first year could be rocky, okay, because you are entering the market. Whether you enter with a lump sum or whether you invest every month, you could see some small decline. It's next year, it could be different things, but you are more likely to gain on year 2. The reason being that you've been through a cycle. As we all know, the markets go through cycles. You get some big highs and you get some low lows. But again, you need to be prepared for that. And this is where coming into the risk analysis. Now, this is not what I put on here, but understanding your risk profile, I would say, is the biggest decider as for how you should invest. So how can I explain that best? What level of risk are you comfortable with? And I'm not saying on a roulette table, black or red. We're not gambling here. We're taking educated, decisions about future. It's about what level of losses. Now, I'm going to clarify losses in a second. Will you be comfortable with before you feel anxious, nervous, worried, and sick? Let's be honest, if you were losing a lot of money, you go through most of those emotions, right? What are you happy with if it's a long-term plan? Okay, and this is where, going back to last week's live, having your plan helps you align with what risk you want to take. Because if your long-term plan is 30 years time, I want my portfolio to grow. Well, if it goes down next year, you're really not worried, because you know over time it's going to grow, and you've got 30 years of compounding growth to look forward to. That's going to be much bigger than a short bit of pain next year. So you may be more comfortable with, if the markets went down 10%, 20%, okay, okay, I'm in it for the long game. You understand there's a long-term gain, maybe a short-term pain as well. It's manageable. Okay, so you would look past it. But if you were very edgy going, oh, 10% loss, I'm really not happy. But if you turn it and say 10% gain, would you be as excited in the reverse of how negative you feel? You have a mix of emotions and going, well, yeah, 10% I'm happy with, but 10% loss, oh no, I'm not taking it. Then that you would be very risk adverse. Okay. And for those reasons, if you feel you would not stomach probably 10 to 15% losses, and again, you should invest more into the bonds. The bonds are much more secure and stable. Returns will probably have anywhere between 4 and 10% normally. And bonds are a slightly different effort. They're normally government backed, security bound as well, property portfolio bonds as well. Big multinational companies often have bonds and things. And that is because they want people to lend and they give them a fixed guarantee, and all of the bonds are guaranteed by the bond. That's where the name comes from. It's a bond to say, I will guarantee your money. Otherwise, you can come after the company before shareholders. So just bear that in mind. If the company went bust, as a bond holder, you would get paid out before a shareholder. So there we go. A little tip for you, just in case you didn't know that's how the market works. And again, all this knowledge you build up over time and you forget that actually, yes, it's really useful. But I'd hopefully not over bombard you a bit. So I just want to give you a broader idea about how the markets work. So with the ETFs, you can go all world or the S&P 500 if you want as your first choice. If you want more growth, if you're a little bit more adventurous, again, not outrageously adventurous, just thinking, oh, maybe I want a little bit more return, maybe do that. And again, start with very small amounts. Start with £100. Keep it low, just go through the motions. And again, reward yourself and take action. So don't put it off till tomorrow, next week I'll do this. Right, £100, put it in and do it now. Because otherwise you keep delaying things, it starts to build the mindset of, I'll wait, I'll wait, I'll wait. And you'll see you're going to be sat on the fence until 2026 and you'll go, I missed another opportunity. And don't get me wrong, I'm not saying now is the perfect time. And again, there are some normal seasonal movements in the markets as a whole. I'll tell you, you do get a Santa rally, and here we are coming into middle of December. You do get a Santa rally. Things come up before Christmas, and things might just go a little bit rocky around Christmas into January, where everyone's kind of back to reality. But again, it's just dampening effect. A 5% downturn, if you like, or a little wobble. It's nothing when you look at the grand scheme of things. So it's like if you invested £100 and the value went down by £5, it would still be worth 95. And this is what I want to make quite clear about losses. Okay, you only form a loss when you sell. Okay, and that's very clear because your value can go down. It does not mean you've lost. Okay, hopefully I've got you there, because you want your nest, your wealth, your value to increase, in which case you gain a profit, which is a profit is difference between its value and what your purchase price is, that gap in between. Yeah, but if on the other side, if the value goes down and there's less than the value you bought it for, that's only called a loss, that part there, when you sell it. If you hold it and ride through the financial turmoil or the movement, just hold it for a longer term, the value nearly becomes irrelevant because you will wait to sell it at a profit. Because we all know over time the value of things will increase. That's the inflation, if nothing else, in which case you will still get your money back with a small profit. So that's something to really bear in mind, that a loss is only a loss when you sell. You can have a lower value, but that's fine. If your goal is to hold things for 20 years and see the value rise in 20 years, but next year the value of your portfolio is down maybe 10%, well, it's not really down 10% as so. because you're not selling, and your value is your sorry, you're hedging your bets on the fact the value will rise in 20 years time. So there we go. So that's the seeing yourself through, identifying your risk, what you're happy with, what sort of ETFs or bonds you should put into your portfolio. So that's given you a really nice overview, I think. And with all the ETFs and with any bonds, any investing, there's two different styles. You can either go lump sum in invest, or you can do every month. There's different scenarios, and again, it's all about what you're comfortable with. If you're beginning, like starting with zero, this is the whole idea of this workshop. Start with zero. I would start with £100 and invest at the end of the month £100, £100. Just get used to taking the action and seeing how things are going. Let the motion and your emotion respond as to how you are dealing with that investment. Is it sitting well with you? Does it make you feel well even if the value is going down? That's something you need to be aware of. Obviously, as you start to accumulate, values will go up and down a lot more, but you'll understand yourself and you'll understand what strategy you're playing for, whether you're on 20 years, 50 years even, or, again, it's looking at your particular need, but you'll understand more if you've started to invest. You're not just reading the books. And again, this is what I really, really try and stress to everybody. Just buy your first share and make it a Christmas present. And now it's perfect, right? December, what do you buy people? Open them a shares investing account and put £50 in there. There you go. Have a very nice Christmas. And treat it for yourself as well, because this is what we forget. It's easier to give than to give ourselves. So start your investing journey and start that. Right, so now we want to go on to the real portfolio. Okay, so I'm going to try. I'm not going to be on a screen share, so I do apologize about this, but I did do my screenshots earlier, and I really hope this is going to come out. So there's my name's at the top, my ISA. So in the UK, we've got our tax ISAs where you can invest £20,000 a year into stocks and shares ISA. That is the tax-free blanket, if you want to call it that. They are perfect for starting. The reason being, you don't get taxed on it at all. Okay, so you don't get taxed on any profits at any time later on. Now, there are some changes coming up. You may have heard in the budget they're going to bring down the ISA allowance, but it's not on stocks and shares, which is this. What they're bringing down the allowance on to £12,000 a year is the cash ISA. The reason they've done that is so you have an 8,000 difference between the maximum ISA allowance, which is this blanket, only 12,000 going to cash ISAs, which is basically with the banks as a saving account. There's an 8,000 gap that you can put into stocks and shares. So the government want to encourage people to put more into there. And I know, because I've been there myself, I used to be a big cash ISA fan at the beginning until I started to see my stocks and shares grow. And then I just started to invest the full 20,000 a year into the stocks and shares ISA and take it, because I was compounding my returns much, much better. And I'm going to show you some really nice numbers in a minute. So my first one here, Invesco, S&P 500. So I invest directly into the US market because the returns are good. And I just want to point out, you see the percentage there, 16%. 16%, that's in just under 2 years. So again, this is where you need to be careful, because my portfolio has grown 16%, but it didn't grow 16% from the beginning because not all the money was in there. Okay, so if you imagine I've added, and I've moved some other portfolio, but the growth to date is 16%. So I'll take it any day of the year. That's a really nice return. I have also tried, and this is what, again, this is where it's about trying things. I haven't done this before, but here you see the UPS and the Global X. those are dividend paying ETFs that I've invested into. And again, it's just to try some different areas because I'm changing my own outlook to generate some more income streams. So again, I'm trying different things. Again, move a small amount of the portfolio into that. And the final part in there was the Wisdom Tree blockchain, because I was an earlier investor in the cryptos, and there was a 81% in 2 years. So a small amount in that pot, as I call it. But again, try it. This is where allows little bits. When you start to invest more, usually more than £10,000, start to diversify a little. Just try little things. What do you feel comfortable with? And this is where it comes down to experience, and exactly what I've done on there. So, and the growth is good. I'm also going to show you the cash ISA. Now you'll see this is over 2 years, 36% up in 2 years. Now that's good investing. It's being strategic. It's having a plan, a long-term plan. For this reason, when I invest into ISAs, because I have experience now, like I say, 25 years in the markets, at the beginning of the tax year, my amount goes in. I seek the benefit of the growth of that tax-free amount as early as possible. When you are starting, I would just invest small amounts as you can and just build up slowly. And again, this is where I come back to the stress again. Action points of start slowly and build your own confidence. So that's the best way to do it. And then once you're happy doing an ISA, your stocks and shares ISA, which is in the platform, this is with InvestEngine, then you can also put your SIP, James's SIP, self-investment pension plan. I self-manage all of my pensions now, and you can do that inside Freetrade. It's just another pot. And the brilliant thing about that, and this is what not many people are talking about, when you deposit into your pension plan, now be careful you can't pull it till you're 55, and I'm getting closer than I'd like to be. When you deposit into it, automatically InvestEngine will do a claim to HMRC for a 20% top up of whatever your deposit is. So think of that as your grocery bonus when you invest into it. And again, that will be tax free, but it is locked until you are 55. And then there are different tax areas on whether you pull out more or not. But it's a really nice way to compound your growth even quicker if you can do that as your long-term portfolio. Because not only is your deposits going to grow, you're going to get a 20% top up from the government. And again, take it. There's a maximum cap. Most people are not going to get to 60,000 a year. And I'm going to add a comment into this. The reason they've done 60,000 as cap is so most people can't reach it. Okay, now it's a government thing that we all know. Politicians do their own thing to help themselves. They can do it because they're earning good money, but most people cannot. So don't worry about it. That's the limit. And you still get your 20% automatic. Normally comes 2 months after your deposit, which is fine. Drop it in. You can set up on InvestEngine, so any deposits that come in, so either your deposit or when you get the rebate from the HMRC, your 20% bonus, that will automatically split into your portfolio however you want to do it. If you're buying some S&P 500, if you've got some bonds in there, we'll look at all of those, but it'll do it automatically. So you really don't need to worry. And that's how you form your portfolio. So that's given you hopefully a realistic overview. And for your action plan, so let's start with the final part, the action plan that we got here. Your action plan is start small, open platform, invest what you can afford, 50 or £100, opens it. You also get your sign up bonus with the links that I got below, which will be great. Helps you get started. Nice little top up. If the bonus is a free share, if you want it, keep it. It's free, take it. Or if you don't want it, just sell it and buy your ETF instead. it's still free. So you just change one for another. But take that as your Christmas bonus. If you follow my link, I get the same bonus as well. So thank you very much. It's just my way to help you. But I genuinely use these platforms. I would not recommend them if I was not happy to use them, like I'll show you here. And the same goes for Freetrade and Lightyear. I actively invest on those as well, in very similar styles as well. Like I say, they're not quite as user friendly, which is why I stress more so for InvestEngine. Nice and straightforward. Set them up in 5 minutes. Make a cup of coffee, then set an account up. Super simple. So work out what platform, what type of ETF, whether you want more conservative, whether you want just the American, whether you want technology. There's lots of different ones, but this is where go back to your thought on what do you want. If you're looking long term, go for a steady Eddie. Go slightly conservative, you've got time. But also the fact is, just try anything. And the thing is, you learn more by buying a part of an ETF, or even if you wanted to buy a stock in your favorite company, do that. You doing the action will teach you more about yourself and what the emotions you go through than just talking, even watching YouTube videos like this. Take the action and learn for yourself, and then you can come back and say, oh, okay, I can see why, if I end up buying lots of stocks, I've got to track them and it gets complicated, and some get dividends and some get taxed, and it can be a minefield. So the ETF really simplifies all of that. So that's the best way I'll go. And again, that's where I have on my portfolio there, the S&P 500 is the favorite for a very good reason. It's got the best or the strongest chance of more upside to come. So even looking into 2026, that'll be my first choice every day of the week without missing a heartbeat. It will be the first pick. So that's where we would go. And again, build the experience is the key thing. And then diversify as your portfolio grows, normally around 10 to 20,000. Start to look around what else to do. So I hope this has been informative for you as to where I would start. Start slow, build up, build your own confidence. And I hope to see you on the next video. We're doing another live next Wednesday. I want to keep these regular, and I hope to see more people come in, so more questions and answers. I am going to do just 3 questions off the top of my head that I had from some friends in the week. So we're going to cover those just very quickly. And and then, yeah, we can join you on the next one. So stick around if you want the questions and answers. Just a second. So I had one friend ask me in the week, yeah, but I'm from the States and doesn't quite apply. It perfectly applies to you. Some of the platforms I recommend are country specific. Because I'm from the UK, most of them will be UK based or European based, in fact, pre-Brexit. There are other platforms for the US. I have yet to find one that I feel very comfortable with. I have joined Charles Schwab before. That was straightforward to set up, but it did take time because you have to sign some of the tax forms. So that can be a lot bit of a delay. The 2 others I know of, one I've tried is Trading 212. You hear that quite a lot. I did try it before many years ago, and I didn't really like it. So that's why I stopped. The other one I've yet to try, but is very popular, is Robinhood. Again, it's building more popularity. And again, I haven't tried it really because I don't need them. But I need to go back and do some more research into next year and just try some other platforms. And again, it's just seeing what changes with the time. So if you are in the States, maybe one of those platforms is better for you. I know some of the other European audience that I have recommend Trade Republic or Revolut. Those seem to be very popular at the minute. The only thing that I don't work well with in those senses, because they come into e-money banks, so they have some exchange system. I don't really get too involved with it, again, because it doesn't kind of affect me. I don't go through all the detail, but just tread with caution. Try them with small amounts. Really, you've got nothing to lose. But do your research before investing larger sums of money with them. They are not the standard bank that you expect, in the same way that the FCA in the UK regulate all of the platforms that take your money. They have to protect client money. So I'm not quite sure how those European ones work. So just bear that in mind at the minute. So that was the second one. The first question, sorry. The second question I had was, can I set up account for my kids? Well, I haven't done that because I'm not affected by that. But it is possible to set up your kids' lifetime ISAs as well. But you invest on their behalf, and obviously the money's locked away until they're 18 years old. Again, it's tax efficient. So using tax efficient investing is going to be your first go-to. So especially if it goes into your kids' accounts, it's going to get them off to a really good start. So when they get 18, they're going to have a nice investment pot that grows over their sort of younger years. So I don't get involved with those, so I can't really pass more than that one on. But I know if you look after your child's ISAs, you can make them grow a lot quicker than just using them as a cash ISA, which is like a savings account just with a tax-free blanket on it. You still get a low interest rate, but it's protected and it grows over time. So, again, and I always get another friend saying, what stocks would I recommend? I've stopped buying individual stocks. I think my last stock purchase was probably about 4 years ago, because I've been burnt. You get sucked into the adrenaline. Oh, you can make this much money and stuff, and some have done really well, but a lot haven't. So again, that's why I consolidated into the ETF style, and part of that is because it's the volatility. If you buy one stock, you're hedging on red on a roulette table, and if it comes black, you kind of can be a bit screwed, and your emotions go up and down a lot more because you're watching the price go, and it will be more volatile. That's why the ETF is a lot more steady, because it's an average of all of those stocks inside that basket. It makes it much more manageable, emotionally much calmer as well. So you can buy stocks, and again, you will be watching the news a lot more. If you're buying all the AI stocks, they're all a big hype at the moment. But the thing is, they're being overpriced at the minute because they're on such a big high. It's been related to the dot-com bubble again, which saw 20% crash. Well, that's why a lot of people are thinking that AI crash will come next year. And so people that buy in now are going to be more affected. So I wouldn't go directly into those stocks at the moment. And that's why the ETFs is fine, because it's a lot more broad and covers you. So it gives you exposure without being at risk. So that would be my advice for you there. If you want to try stocks, try a couple. Again, just a small amount. It gets you familiar with buying an ETF, maybe buy a stock, maybe your favorite car, or electronics. Apple is always the favorite. Just so you just try things, but keep it small. And again, you learn more by trying. So I hope all the action points have been really useful for you. And yeah, I hope to see you on the next video. So if you have any comments, please do drop below. I do look forward to hearing from you, and any feedback is always appreciated, even if it's constructive criticism. I really don't mind. I'm here to try and help serve you and get you on your investing journey, so we can all enjoy financial freedom together. And financial freedom is a lot closer than you think. You just need a plan and a good strategy. So until next time, take care.